It's the Black Real Estate Dialogue. Tune in. Tune in. Tune in. Tune in.
In real estate investing, I kind of always like to go back to the beginning. So we know that any income that you receive is considered income for your tax return, right? So you're supposed to report every amount of income that you receive. So whether it's interest, dividends, your salary, rental income, all of that gets reported on your tax return. And then you go through the return, you subtract out your deductions. Most people do itemized, well, you have either itemized or standard deductions, and then you come up with your taxable income and then you pay tax on that part. When you are investing in real estate, your income, it gets included as well. But what happens is that you get to take your income from investing, so your rental income, and then you're going to subtract out your deductions or your expenses for running your rental. So common expenses include mortgage interest if you financed your property, property taxes, HOA fees, homeowners insurance. If you have a property management company, that's a deduction. If you have to pay utilities, to run the property, or even like once you purchase it and while you're getting it ready to rent, if you have to pay utilities. So any of those things are considered expenses and they get deducted from your rental income. And then that net amount is what goes onto your individual tax return, your Schedule E. But we also have to take into consideration the depreciation. So I wanted to bring that up because if you, a lot of times people are looking at investing in real estate for the income portion of it. So say, for instance, your rental income is $800 a month. And then you take out your expenses and say your expenses may be $300 a month. So you have cash flow of $500. But there's another factor when it comes to your tax return because you get to deduct depreciation. And the depreciation is based off of the value, the cost or the basis of your property. So you're going to take the cost of your property and you're going to add on to that your selling it or your closing costs. So when you purchase a property, say for instance you purchase a property in 2020, when you go to file your tax returns, you want to give to your preparer the closing statement from when you purchased your property so that they can put that on your tax return and they can start calculating the depreciation. That's also good for them because when you sell the property, you get to deduct your basis before you sell it. And we can talk about that one a little bit more towards the end. But just the regular income, so you take your rental income, subtract your expenses, then you get to do your depreciation expense. And that is what becomes your taxable income, right? So if you have a loss, depreciation is an annual deduction. So your rental property, so a single family residence or personal rental is depreciated over 27 and a half years. So you get to deduct you take your cost or your basis of your property, you divide that by 27 and a half years, and you get to deduct as an expense every year that amount of depreciation. For commercial property, it's 39 years. So for rental property, it's 27 and a half. Okay. So what happens at the end is, so you have your income minus your expenses. And then if you have income, net income or taxable income, that gets added to your 1040 and it gets added to just your other income and you're going to pay tax on it. If you have a loss, losses in investment property are considered passive. So generally you only get to deduct the loss to the extent of passive income. So a lot of times you'll have that your passive loss will carry over to the next year. But there's an exception when it comes to rental property on an individual return because they do allow up to $25,000 in losses per year. But your income cannot be more than $150,000. So some people, it's like I was talking to someone recently and they started out where they had deductions for their rental because they had a loss, but then it switched when their income got to be too high. So that's something that you can look into with your tax advisor, tax professional. I like to say you don't go into investing in real estate for a tax deduction, you're looking at it for the long term, right? You're investing in something that's going to appreciate in value, so you want to hold on to it. The tax benefits of it, that's just a plus, right? So that's that little gem. Anybody have any questions so far? No? Okay. So a lot of people are under the, can you excuse me 1 second, please?
Yeah, you can get that if you need to.
Sorry, guys. Sorry.
No worries.
Just a minor crisis. Let me get my train of thought back. So a lot of people are under the impression that you have to have an LLC in order to invest in real estate. And that's not true, because there are a lot of people that have just their rental property on their regular 1040. And if you have an LLC and it's just a single member LLC, it's going to be reported on your Schedule C anyway. So you shouldn't go into it saying, okay, I need to go and get an LLC, because that's not true. The LLC is just protecting you from the liability. So something else to consider is that, is the liability that great to where you need that protection? So if you're investing out of state, like I know there were some houses that were purchased in Detroit, a couple of years ago, and they were like $10,000. It's like, that's not a big risk for yourself, to have to go and get form an LLC. There may be other reasons why you want to form it. Maybe someone's going to come after you. So maybe you want to have different insurance, and usually your homeowner's insurance, I would think, would take care of that. But don't think that you have to have an LLC just in order to have a rental or investment property. So
do you
talk about it? Go ahead.
Do you think I'm glad you mentioned the LLC point, because it's something we've talked about in our chat and people have had questions about. Would you say that getting certain types of insurance, like umbrella insurance or whatever, or things of that nature, do you think that could offer some of the same protections one would think an LLC would protect?
I think that it could, and it's worth discussing it with your insurance agent to see.
Yeah, that makes sense. But yeah, I think the LLC is like a huge thing.
Right?
Yeah.
That's what the LLC is going to do, especially as a single member LLC, and it's a single member, it still comes back to you. So is there a lot of, is there a big, difference between you and the LLC?
Yeah.
So,
makes sense.
So I talked about passive income. So generally it's passive. There was a question that popped up in the chat. So a nonprofit as an entity that holds investment property, that's kind of, honestly, I don't know if you can do that. I think, a nonprofit, the mission of it usually has a mission that's like a community purpose, right? So you have to look at the reason for setting up the nonprofit and what you're intending to get back from it. Like I said, most nonprofits are charitable organizations. They set up to where they receive donations in order to, fund their mission. So what's the benefit of putting a property in it? I think if you're going to have an investment property, then use it for what it is, an investment property, and the tax benefits of it. If there are, they come. But usually it's the investment. You're looking at long-term investing, and that's what an investor is. They're investing for the long term. They're not investing just to get something back right away, or they're not just investing for a tax deduction. It's an investor. So if your intention is to do something different, then you should structure your business differently. But I don't think a nonprofit is the way to go. So, and I'm sure there are rules about that. I would have to do some research, but I can't tell you that one right now. So, so you have your property, and you've had it for a couple years, or you had it for a year, and you need to do some repairs to it. Like you need to paint the walls, or you need to replace the carpet, or maybe if you need to have like a kitchen remodel or something like that. So all of those things are handled differently. Usually painting and carpeting are just considered expenses because it's normal wear and tear. But if you have to replace, like redo your kitchen, then that would be like an improvement. And so then that would be capitalized as well. And you would depreciate that over per like 15 years. So those expenses are handled differently. As far as tracking your income, it doesn't have to be anything fancy. You can use an Excel spreadsheet. It's just a matter of knowing what income you have and what expenses you have. And it could be good to have it in a separate bank account. It's not necessary that you have to, because it's still going to show up on your Schedule E, but it's just good to be able to track the expenses. So sometimes it's easier to track things when it's going into one account instead of using multiple accounts and things are mixed. Not a big deal because it's an LLC. If it was an S Corp, then yes. And if someone was to mention something to you about whether you should be an S Corp, because I know there's a lot of discussion about that one as far as filing or setting up your LLC and then becoming an S Corp. It's not recommended that you hold rental property or real estate in an S Corp because there are built-in gains laws. So if you have a rental property appreciates, right? Then you will, the gain, you would have to pay taxes on the gain in an S Corp that you wouldn't have to pay in an LLC.
Hi everyone, Sam here from the Black Real Estate Dialogue. Make sure to hit that notification bell and that subscribe button and to visit us at blackrealestatedialogue.com.